Do you own a small business and looking for funding? Is your startup struggling to raise funds? Or maybe you have a great business idea, but you need to finance it. Well, you're not alone. Today, we're talking about SBA loans. With these types of loans, you'll have access to the financing that you need, without high interest rates or unfavorable terms. So let's uncover this together. But before we do, subscribe to our channel if you're new to us. And if you're already part of our community, welcome back. What is SBA? The SBA, or Small Business Administration, is a U.S. government agency established to support small businesses and entrepreneurs. Its primary mission is to help these businesses start, grow, and thrive. So, how exactly SBA loans can help your business? Whether you're a fresh startup or an established business looking to expand, the SBA has got your back. The SBA offers several loan programs to assist small businesses. They offer various loan programs for everything, whether for hiring new employees, acquiring a business or a franchise, or even for equipment purchases. The SBA doesn't give out money itself. Instead, they use helpers like banks and other organizations. The SBA makes a promise to pay part of the loans, so it's less risky for the helpers to lend money. This way, small businesses find it easier to get the money they need. SBA loans are there to help small businesses grow or keep going. They make sure the costs for borrowing money are low and that it's easier to pay back. So, what types of SBA loans are available? The Small Business Administration works with two distinct categories of lenders. First up are the SBA approved or preferred lenders. These lenders have been granted the authority by the SBA to make decisions on loan approvals more swiftly. This autonomy can significantly shorten the approval process for your loan. On the other hand, we have lenders who require direct approval from the SBA for each loan they issue. This additional step can influence the timeline of your loan approval, potentially extending the process. The SBA offers 5 main types of loans. Each type is designed with specific goals and criteria in mind. 1. Microloans, Standard 7A loans, SBA Express loans, SBA CDC 504 loans, SBA Economic Injury Disaster loan. So, what are these 5 main types of SBA loans? Number 1. SBA Microloans. If you are a startup looking for a financial boost, but don't need a huge loan, then SBA Microloans are perfect for you. SBA Microloans are ideal for smaller needs. These loans are a go-to resource for startups. You can use them to buy materials, furniture, and supplies, or even stock up your inventory. They're also great for providing that essential working capital to keep your business running. But keep in mind, there are a few things you can't use these loans for. Buying real estate or paying off existing debts. That's a no-go with microloans. If your startup is ready to grow, or you've got a project that just needs that initial push, the SBA microloan program could be exactly what you're looking for. Microloans have shorter maturity terms, usually up to 6 years, allowing for manageable repayment schedules suited to smaller financial commitments. The maximum amount for an SBA microloan is typically up to $50,000, making it a suitable option for smaller financial needs and for businesses that may not qualify for larger loan amounts. Number 2. Standard SBA 7A loans. SBA 7A loan is the most popular choice for most startups and small businesses because of the flexibility it offers. Startups can receive up to $5 million in funding through the 7A loan program. They can be used for buying or refinancing commercial property, new construction, expansion or renovation projects, and for providing working capital. Additionally, these loans assist in business acquisitions or partner buyouts, making them a comprehensive solution for many financial requirements. The SBA 7A loan program offers varying maturity terms and a generous maximum loan amount. Loan terms extend up to 7 years for working capital, 10 years for equipment, and 25 years for real estate. The maximum loan amount available under this program is $5 million, catering to a broad range of business needs. Number 3. SBA Express loans. If you're a startup and find that the standard SBA 7 loan isn't quite fitting your needs, the SBA Express loan program might be just what you're looking for. The SBA Express loan program stands out for its expedited approval process, usually within 36 hours. It's designed for businesses needing fast access to funds, differing from the standard 7A SBA loan. The maximum loan amount for SBA Express loan is $500,000, streamlining the qualification process compared to other 7A loans. Typically, the maturity for SBA Express loans varies based on their use. For instance, if you're using the loan for working capital or daily operational costs, the repayment period can be up to 7 years. On the other hand, If the loan is for purchasing equipment, you might have up to 10 years to pay it off. This flexibility in the repayment schedule is one of the key benefits of the SBA Express loan, making it a popular choice for small business owners who need quicker access to funds with manageable repayment plans. Number 4. SBA CDC 504 loans. The SBA 504 loan program is tailored primarily for financing commercial real estate projects. This includes buying or refinancing existing buildings or land, as well as funding new construction. Additionally, these loans can be utilized for significant equipment purchases. The CDC's portion of the loan is backed by a guarantee from the SBA. To streamline the process for the borrower, the bank's SBA specialist and the CDC collaborate closely, aiming to provide a smooth and integrated experience for the loan applicant. This collaborative approach between the private lender, CDC, and SBA makes the 504 loan a viable option for businesses looking to invest in long-term assets like real estate and heavy equipment. Let's look at the qualifying criteria for SBA CDC 504 loans. To be eligible for a 504 loan, your business must operate as a for-profit company in the United States or its possessions, have a tangible net worth of less than $15 million, have an average net income of less than $5 million after federal income taxes for the 2 years preceding your application. These criteria are designed to ensure that the SBA 504 loans are accessible to small and medium-sized businesses genuinely in need of financial support. What is the loan maturity for SBA CDC 504 loans? If you're getting this loan for equipment, you're looking at a maturity of up to 10 years. But if you're using the loan for purchasing, refinancing, or constructing owner-occupied real estate, the maturity extends up to 25 years. This extended period is especially helpful for significant investments in your business's infrastructure. Refer to blog.circular.io for more details. Number 5 is the SBA's Economic Injury Disaster Loans, also known as EIDL. EIDL loans can be used to help a business recover from an emergency in a declared disaster area. They can be used for losses not covered by insurance or funding from the Federal Emergency Management Agency. If you would like to learn more about this loan, visit our blog. We have shared the link in our description. Now, who can apply for SBA loan? Qualifying for a startup SBA loan involves meeting certain criteria set by the Small Business Administration. While the specific requirements can vary depending on the loan program, here are some general qualifications that startups usually need to meet. The business must be officially registered and operate legally. The business should operate for profit. The loan must be used for a business purpose only. This includes expenses such as equipment purchase, working capital, inventory, or real estate. The business should be registered and operate in the US. Be a small business under SBA size requirements. Not be a type of ineligible business. We added the link to the list of ineligible business in the description. Not be able to obtain the desired credit on reasonable terms from non-federal, non-state, and non-local government sources. You may get denied an SBA loan if your business could obtain financing elsewhere or has a wealth of assets above the loan amount requested. Be creditworthy and demonstrate a reasonable ability to repay the loan. Startups need to demonstrate the potential to repay the loan. This can be challenging for new businesses without established financial histories, but projections, business plans, and personal financial strength can help. If you're seeking any type of SBA loan, there's a good chance you'll have to provide both collateral and a personal guarantee. Without them, you'll have trouble getting an SBA loan. However, smaller loans do not require any collateral. For instance, when applying for loans of $50,000 or less, SBA does not require collateral, except for international trade loans, which have different requirements. Each SBA loan program, like the 7A, 504, and microloan programs, has its specific criteria and conditions. So it's important to check the requirements for the particular program you are interested in. When applying for an SBA loan, it's essential to include certain financial statements to support your application and demonstrate your ability to repay the loan. These key documents include year-end profit and loss, P&L statement for the last 3 years, year-end balance sheet for the last 3 years, including a detailed debt schedule, reconciliation of net worth, interim balance sheet, interim profit and loss statements, projected financial statements, including month-to-month cash flow estimates for at least 1 year. Organizing and preparing these documents can be simplified with circular.io, saving you and your accountant time and helping efficiently prepare projected financial statements for loan applications. Additionally, individual lenders might have their own specific requirements on top of the SBA's criteria. For instance, Pursuit as an SBA-approved lender in New York, offers the SBA Microloan program with specific criteria designed to assist small businesses. To be eligible for automatic approval in the Pursuit Microloan program, the following requirements must be met. At least 2 years in business. Your business should employ 2 or more people. The business should have positive or break-even cash flow. The business owner's personal credit score should be 640 or higher. The business should not be home-based. The business should have more than $120,000 in annual revenue. There should be no liens or judgments filed against the business or owner within the last 3 years. Neither the business nor the owner should have any prior bankruptcies. It's important to consult with an SBA-approved lender or a Small Business Development Center (SBDC) advisor to understand the specific requirements relevant to your situation and the particular loan program you are interested in. When you're applying for any loan, including SBA loans, having your financial books organized and up to date is crucial. This is where Circular.io comes in. Circular.io simplifies your bookkeeping with advanced AI, turning complex receipts into clear journal entries. No need to be a finance expert. Our intuitive platform makes tracking invoices and managing accounts easy, giving you a clear financial overview. This is crucial for loan applications, as lenders scrutinize your financial history. By using Circular.io, you can easily organize your receipts and ensure your financial records are accurate, updated, and readily available for any lender's scrutiny. Subscribe for more insights and make managing your startup's finances effortless with Circular.io.